On Business Incorporated today. Libya oil production up by 300,000 barrels per day. Regulator announces another cut in fuel prices in Zimbabwe. And we take a look at South Africa's interest rate hike, the expectations and consequences. Good afternoon. Welcome to Business Incorporated on Channels Television. I'm Ini John Mekwa. We'll start as usual with market numbers, and it's a red day for a lot of markets at intraday and even closure of markets on Thursday. Starting here in Africa, we see the numbers there. Nigeria's NGX sustains that red and bearish sentiment, is down 0.05% at intraday 49,165.55, while South Africa is flat, but it's still bearish there, 63,846.97. In North Africa, the EJX 30 follows that trend, is down 0.23% at 9,933.05, while Kenya closed yesterday also in the red at 0.16%. In the Middle East, still persisting red markets from yesterday at the close of trade yesterday. They are not open today. Abu Dhabi shed 0.40%. Dubai also down 0.75%. And then when we go to the other part, Saudi Arabia is 0.37% in the red, and Qatar lost 0.09%. All right, so let's go to other market now. We go to Asia. Asia Pacific shares fell on Friday as investors continue to weigh the Federal Reserve's aggressive stance. In Australia, the S&P X 200 fell to its lowest, and there we see the Nikkei also is down 0.58%. The Shanghai Composite is down 0.66%, and the Hang Seng Index is down more than 1%. That's what we have at intraday. Well, mainland China stocks were also lower, with the Shanghai Composite shedding 0.66% to 3,088.25, and the Shenzhen Composite also lost. MCSI Broadex Index of Asia Pacific shares outside Japan was down more than 1%, while Japan markets are closed on Friday for a holiday. All right, so in the United States, stocks on Thursday posted their third straight daily decline, as mounting fears that the Federal Reserve is aggressive rate hike will push the economy into a recession and dented appetite for investors. The S&P 500 we see there is down 1.33%. The Dow Jones futures also down 1.25%. Nasdaq is down also almost 1.5%. Yet for the futures at 11,395. Now, the Dow Jones is having not a very good day, and bond yields surged yesterday, with the yields on the 10-year and 2-year Treasury notes notching fresh multi-year highs, hitting the highest levels since February 2011 and October 2007, respectively. And now going to global oil now, prices fell on Friday as demand fears were stoked by rising interest rates and a stronger dollar, though losses were capped by Moscow's mobilization campaign in its war with Ukraine, an apparent deadlock in talks on reviving the Iran nuclear deal. Brent crude futures fell by $2.81 to $87.65 a barrel. Also, West Texas Intermediate crude futures was down, retreating by $2.03 to $80.56. Front month Brent and WTI contracts were down more than 4% and 5.37% respectively over the past week. All right, just before we continue with some of the stories in the oil space, let's go to our London studio where Juliana is standing by. We started this conversation in the morning, Juliana. Good afternoon. I know now we've had a lot of reactions following the announcement of the mini budget. What are the reactions? What are the conversations going on with that?
Well, I think it's fair to say that the reaction hasn't been good, and that's across all sectors, markets. The pound has been tumbling. It's had a fresh 37-year low against the US dollar, and all of the indexes are down at the moment. I think, it's fair to say that Kwasi Kwarteng, the new Chancellor, the first black Chancellor, which for us black Britons is a big deal, so it's worth stating because you won't hear it anywhere else. He has a tough time at the moment, because, of course, he's trying to balance a very, very delicate, difficult tightrope. On the one hand, cost of living crisis, high inflation, heading to recession, people need help and support. On the other hand, you give the help and support, who's going to pay for this? It's not good enough. So, yes, I'm sure he's got a very sore head, but down to the politics. We had a 10-day break, didn't we, for the Queen's death, and it appears as if in the past couple of days, since government businesses have been back up and running, we've had 10 months' worth of government policy, and it's all about this budget today. It was described by the Conservatives as a mini budget. It's anything but that. Kwasi Kwarteng, and obviously with the support of Liz Truss, who's Prime Minister, very close ally, they have gone in full steam ahead. They have spent billions upon billions of pounds this morning, and they've cut taxes worth billions of pounds. And the big question is, who is going to pay for it? Some of the headlines that have come out from today's mini budget is, first of all, corporation tax. Corporation tax next year was supposed to climb from 19 to 25%. That is not going to happen. So now Kwasi Kwarteng believes that if you make Britain competitive, business will want to invest here, and therefore growth will start to stimulate. That's the plan. We'll just have to wait and see. He's also done a huge U-turn on his predecessor, Chancellor Rishi Sunak's plan, which was to hike national insurance. It was hiked in April. That is going to be scrapped come November the 6th. So more people will have more money in their back pocket. And this is where now it gets political when we talk about the tax bans. We have 4 tax bans in the UK. If you are a very top earner earning over £150,000 a year, you were paying 45%. You no longer will pay that. And that's what Labour are running with now. Because, of course, if you are earning that much money, you have a little bit more to play with. You don't need a huge tax cut. He's given it to them, and Labour feel that he's not given it to those who are on lower tax brackets who need it. However, there is going to be a 1p deduction from the 20% tax to 19%. So that is a good thing. But the Labour Party conference is coming up this weekend. There had been discussion about whether or not Sir Keir Starmer, the Labour opposition leader, had enough steam to go ahead, head-to-head with Boris Johnson. Apart from Partygate, there wasn't much in policy. Now they've got this because they believe that Liz Truss's economic plans are very, very conservative. They only protect the very wealthy, not protecting those who are poor. Not great for Kwasi Kwarteng. First outing, it was not great for him. He is being slaughtered by the British press at the moment. But we just have to wait and see. Most people do want to keep more of their earnings in their back pocket. But is it going to be enough to keep Britain out of recession? Only time will tell.
Yeah, Juliana, a whole lot to digest there. And I know in the coming days, we're going to have more conversations about this and the consequences and the implications to individuals and the economy. But how's the market taking it?
As I was saying, not great, particularly government bond yields and debt, because, again, all the economists are saying, where is this money going to come from? Jacob Rees-Mogg, Business Secretary, announced that a blanket of support going over businesses, which is going to last for 6 months. That is going to cost about £150 billion, as well as the £2,500 a year freeze on energy bills. That's going to cost money. And now this, if you are buying government debt, now is the time to run away. And that's what we're seeing reflected, but it's also being reflected in the all share, which is down triple-digit figures, 1.76%. FTSE 100 down too by 1.79%, and the FTSE 250 that's down by 1.68%. As I was saying, the British pound is taking a huge battering against the US dollar. I think it's worth about one pound will get you $1.13. That is significantly low. That's a 2.02% drop. We've not seen that much in a very long time. The British pound is also trailing against the euro by 1.20%. And at intraday, the British pound is down on the Japanese yen by 1.50%.
All right, a whole lot of things happening in the economic scene there in the UK, but we're here to report to Juliana, and we trust you there as our eyes and ears.
Thanks, Innie.
All right, so let's move on now. We're going to Libya, where the oil production rose by 3,000 barrels per day to 1.186 million barrels per day. Higher supply from Libya could raise or ease upward pressures on oil prices, which have been falling in the recent weeks amid fears of recession as central banks continue with aggressive interest rate hikes to curb inflation. Still, Libya continues to be a wild card on the oil market despite stabilization of its oil production over the past month. Since the end of August, Libya has been pumping close to or even above 1.2 million barrels a day, a level last seen before the port blockades that began this spring. Libya's oil production has recovered in recent weeks after the country resumed oil exports in July. The first tankers arrived in Libya to load oil for export in mid-July, ending a force majeure on key oil fields and ports that had been in place since April. The force majeure severely crippled Libya's oil exports following weeks of protests and closures amid the new rifts in Libya's political class over who should be governing the country. And still in that oil space now, but in Zimbabwe, the country's regulation authority has announced another reduction in the prices of fuel. The retail price of blend is now $1.52 down from $1.53. Diesel prices remain at $1.74. The authority says operators are obliged to display prices at their retail outlet at a prominent place in clearly legible letters. Meanwhile, blending ratio remains at E20. Going to the metal space now, gold prices dropped more than 1% to their lowest since April 2020 on Friday, as a cocktail of factors from robust dollar and elevated U.S. bond yields to worries around more U.S. interest rate hikes diminished bullion's appeal. Spot gold was down by 1.7% at $1,642.79 per ounce and was heading for its second straight weekly decline, and that's down by 1.8%. U.S. gold futures fell 0.5% to $1,672.10. Cutting gold's slipstream spot silver dropped by 3.3% to 19.01 per ounce. Palladium slipped 3.6% to $2,091.91. And platinum dipped 2.7% to $875.97. All three metals were heading for weekly declines. We'll take a break now. When we come back, we'll head straight to the African continent. So more stories from there. We've had some already. This is Business Incorporated on Channels Television. You're welcome back. You're still watching Business Incorporated on Channels Television. Well, it's a season of rate hikes, and South Africa joined that yesterday. Well, not joined because it's the second time they're hiking rates yesterday, and they hiked by 0.75 basis points at their second meeting in a row, moving the repo rate to 6.25% and the prime rate to 9.75%. Or let's listen to the governor of South Africa Reserve Bank now after that meeting.
The MPC decided to increase the repurchase rate by 75 basis points to 6.25% per year with effect from the 23rd of September 2022. 3 members of the committee preferred the announced increase. 2 members preferred a 100 basis points increase. The level of the repurchase rate is now closer to the levels prevailing before the start of the pandemic. The revised repurchase rate path remains supportive of credit demand in the near term, while raising rates to levels more consistent with the current view of inflation risks. The aim of policy is to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of hitting the inflation target in 2024. Guiding inflation back towards the midpoint of the target band can reduce the economic costs of high inflation and enable lower interest rates in the future. Achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains would enhance the effectiveness of monetary policy and its transmission to the broader economy.
Well, to delve into that and matters arising around that, we have Matt Kindiger, Practice Lead, Sub-Saharan Africa, in front of you. Hi, Matt. Good afternoon. Good to have you. So, I mean, it seems like it's the in thing now. Everybody's raising rates to tame inflation. But really, how effective is interest rate hike in curbing inflation? Oh, okay. Matt, can you hear me? Seems Matt cannot hear me, so we'll try to fix that and get back to Matt Kindiger there to have that conversation. While we are working on that, still in South Africa, Agri South Africa says it has requested an urgent meeting with Eskom Chief Executive Officer to discuss the outlook for load shedding in the country ahead of the summer crop planting season. The Federation of Agricultural Organizations says it fears the current state of energy supply in the country, should it continue at this level, will have harsh implications for local food production and may also jeopardize export agreements. Agri-SA says in a statement that the greatest threat of load shedding is to the country's food security as crops fail for lack of irrigation or farmers plant less for fear of losses, and further warned that load shedding means bad news for the industry's international relationships as persistent power cuts interfere with cold chain protocols mandated by foreign markets and can result in late shipments. All right, I believe we have Matt now. Matt, can you hear me now?
Yes, I can.
Awesome. So I was saying that, I mean, it seems like it's the in thing now. Everybody's raising rates. Everybody's hiking every MPC. But really, how effective is hiking interest rates in curbing inflation?
Yes, so in South Africa's case, it's pretty mixed. And to be honest, we think it's going to be fairly limited. And this is because in South Africa, the drivers of inflation are really broad-based. There are a number of things raising the inflation rate at the moment, and these are both external and internal. So from an external perspective, we have extremely high global commodity prices, especially for fuel and food. This is really driving the cost of the rate of inflation in the country. We're also seeing the rand lose value against major currencies like the dollar and the euro, and this is driving up the price of imports. And even though interest rates in theory should increase, should support the value of the rand, we're seeing it have very limited effect because at the moment globally there's a flight to safety, especially the US dollar, and this is dragging down emerging market currencies like the rand. Additionally, in South Africa, we've seen some domestic drivers of inflation, such as energy prices. We don't see these changing. We expect to see energy prices, especially electricity prices, continue to rise as the state-owned electricity utility Eskom increases utility prices. So certainly there will be very sort of limited impacts of these interest rate increases, at least over the next few months, on the rate of inflation. We expect inflation to reach at least 10% by the end of this year and then begin to fall afterwards.
Yeah, well, you did say that various factors, because we just heard how food security is being threatened also by load shedding. So obviously that's also another factor. But how will all of this affect the growth outlook of the country?
So it's moderately negative in our view. It won't fundamentally derail the outlook for the economy, but high interest rates will certainly contribute to a slower growth outlook. We have recently revised down our GDP growth forecast for South Africa from about 2.2% for this year to 1.8%, and we expect it to be around about 1.5 or 1.6% in 2023. Load shedding, increasing food prices, but also rising interest rates are all contributing factors. When we look at interest rates more specifically, what we did see during COVID and up until as recently as October 2021, so just under a year ago, interest rates in South Africa were at a record low, and this was a lifeline for the South African economy. And it's one of the reasons why the services industry in particular did very well. So now that we've seen interest rates reach more or less back to their pre-COVID levels, we will begin to see less dynamic growth in investment, especially capital investment. And we will also see the government's debt servicing costs rise as well. So this will really curtail government spending growth and investment. So certainly it will have a fairly or moderately negative impact on growth over the next year or so.
And I guess that negative impact will also spill over to the rand.
Certainly. So the rand has been really battered by quite significant volatility over the last couple of months, and it has depreciated beyond our original expectations. So the rand is a very highly traded currency globally. It's one of the most traded emerging market currencies. And it really is, as a result of the flight to safety by investors to the US dollar, lost quite a significant amount of value. The interest rate increase in our view, or these recent interest rate increases by the South African Reserve Bank, will prevent even more depreciation. So in our view, in the absence of these interest rate increases, the rand would have depreciated a lot further and a lot more than what we're currently seeing. But we are still expecting to see the rand continue to lose value, especially as we look towards the ANC National Conference at the end of this year, and especially longer term, the election in 2024, we expect investor anxiety to increase. So certainly we are expecting the rand to remain above 18 per dollar over the next year or so, and it could get as close as 20 for a sustained period of time. So certainly some more downward pressure, although these interest rate increases are curtailing the extent of the depreciation.
All right, Matt, thank you so much for sharing your research and findings with us. Enjoy your weekend.
Thank you, you as well.
Well, with Matt, we say thank you for being a part of Business Incorporated for 5 days in a row, being a jolly good ride, I would say. But we'll start off again next week, Monday, God willing. We'll be here to give you updates from the world of business. I will see you tomorrow, God's grace, during capital markets, where we'll do a summary of happenings in the capital markets, in the different markets. We'll meet tomorrow, 7 p.m. at Capital Market. I'm Ini John Mekwa. Enjoy your weekend.